I'm Josh Gottbaum. As Doug mentioned, I'm new to Brookings, having just spent 4 years running the Pension Benefit Guaranty Corporation. And I think the reason I was asked to moderate, other than the fact that I was a warm body, is I've been both a regulator and a deregulator, and I've been both an asset manager and a managed asset. When Doug asked me to do this and laid out the structure of the event, he said we're going to have a discussion of the broad economics, and then we're going to have a discussion of the government activities, and then we're going to have a discussion about policy making and regulatory. My initial reaction was, why are you having the government talk first before you actually talk about the regulatory requirements? And I realized, looking at the subject matter, that that was precisely the right approach. And the reason for that is that the position of the folks who are going to speak to us this morning from the government is not yet one of policy prescription and policy making. That where the government, the various government agencies that care about this are, is in an assessment and an analytic role. And I thought it would be worthwhile pointing out that that is necessary, and as a person who's been in and out of government and been both the perpetrator and the victim of regulation, that the task of the government is not the same as the task of the previous panel. The previous panel had to express opinions that were plausible, grounded in facts, etc. And they did not have to worry about the institutional implications of those opinions. And so the brilliance of Doug's ordering is that it gives the folks from the government whose job it is now to assess and do analysis a chance to talk about the assessment process, to talk about the analysis, and that is what our panel is here for. It is inevitable, after you have had an historic financial collapse due in important part to the lack of understanding both of the nature of some financial products and the interrelationships between the institutions, that there would be a series of reactions. Dodd-Frank was one response. And what the government is doing is carrying out its obligation to go beyond the bank depository institutions and look at the systemic implications of other institutions. It is also important that they not peremptorily exempt a class of institutions, which is why asset management makes sense. So with that, I'm going to bring up the panel. You should, we're going to start with Nellie Lang. Nellie runs the Financial Stability, the Office of Financial Stability Policy and Research. She has had a history of career hopping. She joined the Fed in 1986 and never left. She'll be followed by Patrick Pinchmit. Patrick is the Deputy Assistant Secretary and who is in charge of coordinating the FSOC. His history beforehand includes working for the Congressional Oversight Panel on the TARP, chaired by one Elizabeth Warren, not then yet a senator. Before that, for a long time, he was an analyst covering financial institutions. And at the end, we will have Mark Flannery, the chief economist of the Securities and Exchange Commission, where he has been for all of 4 months. As Mark puts it, this is his first stint in the non-academic world. And so, without further ado, Nellie?
Here we go. Okay, so thank you very much for inviting me, Doug and Josh, and glad to be here to speak on asset management and financial stability. These comments, because we're government, I'll start the government panel off correctly, just to give my standard disclaimer that the comments are mine and not of the board or its staff. So I'm going to, obviously we've just had a panel where we've had a broad review of the asset management industry. I'm going to focus financial stability risks. In my 5 minutes or so, I'm actually only going to make a few points about open-end long-term mutual funds, and hopefully just a way to get some discussion going. So my points, first, I would note that mutual funds in their current form have been around for a long time, 75 years now, and they've weathered all kinds of adverse market conditions without noticeably contributing to systemic risk. Indeed, they may provide a diversity of sources of funds for borrowers and may have had stabilizing influences on aggregate credit. What I want to show is that these funds have grown relative to the economy and to the rest of the financial sector. I will argue that while mutual funds are still largely a simple intermediation function between borrowers and savers, that intermediation has gotten somewhat more complex. And I'll use two simple examples to make this point. One is their move into more illiquid assets. And one example of use of leverage in that case is derivatives to gain exposure. The growth of funds and their greater linkages with other financial intermediaries does raise the potential that their actions under stress could have effects on the broader financial system. One example is that risk management at individual funds may not be sufficient for systemic risk if, for example, risk management ignores some sources of risk, systemic risk, such as correlation risk. That's just an example. Before I get into I'm going to just have like a couple slides with some pictures. Before I get into that, I do want to emphasize the issue for financial stability is not about market risk or the volatility of asset prices that are just part of the normal functioning of capital markets and capital allocation. Neither micro or macro prudential policies are aimed at regulating asset prices. That is not the intent. The case for policy here is if the structure of the intermediation were some ways would amplify shocks and beyond the value of the fundamental value of the security. So really is an amplification mechanism. Is there something about the structure of funds? Okay, so my first slide. Many of these issues I'm going to discuss were already talked about this morning. I guess I'm going to bring some pictures to some of that, and maybe that will cement some ideas. This is a chart designed to help us put long-term mutual funds in perspective. And it's measured by holdings of credit market debt outstanding in the financial sector. So first of all, the time series is from roughly 1957 to current. It's credit market debt outstanding. So think of this as these are bonds. It does not include equities. Currently, it's about $40 trillion relative to nominal GDP, which is what it is scaled to. It's about a little under, 250% of GDP. A couple things to point out. This blue on the bottom is the banking sector. It's the banks and the bank holding companies, and I believe maybe credit unions are there. And it starts in the early 60s or late 50s at 50% of nominal GDP. It's now maybe 70%. So the point is the banking sector share of credit market debt outstanding is not rising that quickly. And as you can see, it's becoming a much smaller share of total financial intermediation. The mid-'80s was a breaking point where financial sector credit market debt outstanding started to increase a lot. Some of the increases that are very notable is this dark blue, that is the GSEs. I would highlight this red area, that's private ABS, not mortgage-backed securities. The yellow is the long-term open-end mutual funds and ETFs. So it's not a huge share. It is clearly a growing share. And since the crisis, it is the fastest growing share. So as assets came out of other types of financial intermediaries, they're moving to these, again, are the open-end long-term mutual funds and ETFs that hold bonds, not equities. Currently, our flow of funds estimates have that at, I think, 4.7 trillion. So my only point is this open-end long-term mutual fund sector is increasing. And the questions are they becoming more connected to the rest of the financial sector? Or are there ways, even within that sector, as they get bigger, are they more connected to each other? Okay. Again, so I'm going to do two simple examples just to give a concept of liquidity and leverage. Okay. So liquidity risk. As the mutual funds have become more specialized, have grown, become more specialized, we have seen this move into less liquid markets. I'm going to show one example here. This is the high yield bond market. Matt and others mentioned emerging markets. There's other assets that are less liquid. This chart to the right shows the high yield bond market itself. The red line has been growing pretty quickly. It's kind of doubled since 2008. This capital markets as we move away from bank debt. The blue line below is the high yield bonds and ETFs, mutual funds and ETFs. That's grown also probably a little bit more than doubling, and this is the share. It's just annual data that's since the crisis, it's risen. It's up a little bit, 30 to 35%. So this clearly puts more funds in a position of being expected to provide investors liquidity against assets that have become less liquid. So as mentioned earlier this morning, investors in these funds face a first mover problem, albeit it is one much less severe than you would think of bank deposits in a classic Diamond-Dybvig framework. But the first investors to redeem are more likely to get paid out with cash or the proceeds of liquid securities rather than the proceeds of forced sales of less liquid securities. This puts liquidity risk management for these funds front and center as at a critical point. For financial stability, the issue would be to what extent do fund managers anticipate that redemptions at their fund will happen exactly at the same time as it's happening for other funds. So that's the systemic issue. Now, there is a little bit of research on the effect of illiquid stocks and subsequent returns. The literature is not big. And then more recently, if you have common holdings and illiquid stocks, do you have lower subsequent returns? And I think the answer from that literature, again, it's not very big, is yes. Is the effect big? We don't know. In stocks, probably not very big. In these bonds or emerging markets, I think the answer at this point is we really don't know. We can say, though, that things have changed, and it's bigger than it used to be. But I think that's an area for quite a bit of research. And I would make a point that it's very difficult for researchers to collect the kind of bond data at the fund level that they need to do this analysis on an aggregate basis. I think you can collect fund by fund. So that's an area that I think will be important for us to focus on. Okay, second example. I'm just going to use one example to show that funds have limits on leverage. They may be using more leverage, we don't know. And again, I'll make a point, it's very hard to see. So we know that funds can use derivatives to gain exposure. It may be a way to manage their inflows. It may be a way to juice returns. We don't know. And there are limits on what they can do, and some do it, and it's not, we don't know if it's how big it is. So this is an example of the credit default swap market. The data I'm showing are credit defaults cleared through DTCC that are in which either the reference entity or one of the counterparties is a regulated Fed entity. So it's not a complete snapshot. We do have one complete snapshot. This is roughly about 65% of the market. I can show you the complete one if you want. In 2013, the aggregate notional amount in this market was about 15 trillion. Dealers are by far the biggest actors in this market. So the total is, say, 15 trillion. Dealers are about 12 or 13 trillion. No question they're the biggest. Other actors, though, are bank non-dealers, hedge funds, and asset managers. And so you can see they buy and sell, and they're active. This varies over time. So in this case, it shows hedge funds are net buyers, asset managers are pretty much flat, but on net a buyer. But over time, this varies, and sometimes they're net sellers, and we see that. CDS exposures clearly create some embedded leverage, links them to other levered financial institutions. This makes these funds part of a bigger, part of the broader network. If they face redemptions at a time, they have to pay off on a default. Is that part of liquidity risk management? I think that's really the issue. We have a very incomplete picture of what's going on here. With the outflows from PIMCO over the last summer, people were all pointing to their public reports. They reported $38 billion in notional net sold, but you can't create any kinds of linkages. So this is an area that we want to do a little bit more. Okay, let me just conclude. I guess let me just conclude just to make my points. Long-term mutual funds are an established, time-tested part of the financial system, American financial system. They're using derivatives to obtain exposure, growing presence in less liquid markets. More generally, link them to the rest of the financial sector. And it's possible potential risk for financial stability may be changing. The responsibility of the regulators is to do that evaluation. And it's clearly the case that even if there are rules and regulations and good risk management on the parts of individual fund managers, there could be financial stability risks because of neglected risks. Okay, thank you.
Sorry, I'm a little slow on this one. Okay, thank you very much, and Doug and Josh, thanks again for having me here today. Basically, I want to cover two key points this morning. One is provide some framing around the council's ongoing work on asset management, and number two, hit on some of the high points and details of the council's recent Federal Register notice requesting comment on asset management products and activities. Before doing that, I think it might be useful to provide some grounding on the role of the council and the mandate of the council. As we saw back in the financial crisis, one of the lessons, of course, from the crisis was that risks aren't always neatly packaged in tidy verticals relating to specific institutions, specific markets, asset classes, or for that matter, regulatory jurisdictions. So one of the aims of Dodd-Frank and specifically relating to the council was to provide a mechanism for regulators to come together, to have collective responsibility to identify and respond to risks to financial stability. To the extent that the council identifies risks, there are certainly a menu of options available to the council on that front. One option is highlighting a risk in the council's annual report. That can go as far as making a recommendation, or it could be as simple as just sort of noting something, putting it in a text box, or talking about it. Another option available to the council is to work with primary regulators in the industry to improve data, improve availability of data, or improve transparency generally to market participants. Another option still is to make a recommendation to the primary regulator calling for a certain action or making a recommendation regarding a certain action. And certainly in the case of company-specific or individual firm risks, there is, of course, also the option of designation. So now turning to the council's work on asset management, I think the first thing I want to point out, and I think Josh hit on this too, is it's certainly very premature right now to even talk about any sort of course of action for the council. I mean, the council is firmly and squarely in the risk identification phase of its work. And that's been going on for over a year now, trying to get an understanding of potential risks and doing some analytical work. This has been informed back in May. The council hosted a public conference bringing together the various stakeholders, many of whom are actually here again this morning, to talk about risks in the asset management industry. And then following that conference at the end of July, the council directed member agency staff of the FSOC to prioritize a review on asset management activities and products. So that brings us to where we are today, kind of building on these and other efforts. Towards the end of December, the council unanimously approved and issued for public comment a Federal Register notice seeking comment on asset management activities and products. Now, let me talk about that notice briefly. The Federal Register notice, at its heart, provides a vehicle to engage, for the council to engage with the public in a very targeted manner. There are four primary risk buckets that make up the meat of that register notice. The first one is liquidity and redemption risk. The second one is leverage. The third one is operational risk. And the fourth one is risks relating to resolution. Within each of those sections, the notice is organized in such a way where at the beginning of the section, there's a discussion of the potential risks. The middle part of the section attempts to talk about industry practices and regulatory practices that could potentially serve as mitigants and could potentially curb the risk. And then finally, each section concludes with a series of targeted questions, trying to get at more information and trying to kind of get a better appreciation for the risk. So now I can actually turn to my first slide. Before kind of getting into the key risk buckets highlighted in the Federal Register notice, I think it's important to provide four important points of context here. The council is not seeking to undo the normal risk-reward dynamic in the marketplace. Investment risk is clearly a fundamental part of the marketplace, and it represents a normal part of market functioning. Rather, what the council is going after and looking at is trying to understand whether there's certain parts of the structure or mechanics of asset management activities that could create, amplify, or transmit risk more broadly than would otherwise occur. Second key point is the council's threshold for action is threats to U.S. financial stability. That's a lot different than the role of the primary regulator, where there's prudential regulation and investor protection. And I would note that, and Mark will surely talk about this, Chair White recently noted that the SEC is considering several initiatives in this area, and Chair White also went on to note that in terms of her view of the role of the FSOC, she views it as complementary to what the SEC is doing. Third key point is regulators, industry, and stakeholders have been engaging in a debate for many years now. There are a lot of questions out there. There's ongoing back and forth. And to a large extent, the Federal Register notice that the council is put out reflects that debate and kind of reflects some of the ideas in a more targeted fashion. And finally, fourth point is, high quality data and information is absolutely essential to what the council is doing. The council plans to assess whether, as part of this notice, whether there's sufficient data out there, whether more data would be needed either to improve transparency or to improve information in the marketplace for counterparties. So with that, I'll turn very quickly to the substance of the notice. I'll highlight on kind of the key areas and talk about the key points within each, as well as the type of information that the council's looking for. The first area is liquidity and redemption risk, and this section focuses on whether there are certain structural features of pooled investment vehicles, as well as their management of liquidity and redemptions, could potentially influence investor behavior in a way that could affect U.S. financial stability. More specifically here, the council is exploring the implications of potentially greater redemption incentives for investors in pooled investment vehicles based on the fact that the costs associated with redemptions are shared and, as a result, partially borne by remaining investors in the vehicle. So the punchline here is there a first mover advantage, and could this dynamic be magnified for investment vehicles focused on less liquid assets? Turning to leverage, the leverage section focuses on two key risks. The first is the degree to which the use of leverage by investment vehicles may increase the potential for forced asset sales. And the second point is the potential for leverage investment vehicles to expose counterparties to unanticipated market risks. For example, do declines in asset prices lead to collateral or margin calls? Could that create a sort of a vicious cycle? And can risks materialize via counterparty exposures, creating distress of a leveraged investor and transmitting that to the broader financial system? The third section is operational risk, and there are two kind of key areas to this section. The first part is the transfer, the ability to efficiently transfer client assets and accounts from one asset manager to another, particularly in a time of stress. The second point is trying to look at the industry in terms of, is there an over-reliance on certain parts of the industry on third-party vendors or service providers that could potentially pose risks if one of those were to encounter some problems. With respect to the transfer of client assets and accounts, the council is seeking to understand the resiliency of market structures to handle a scenario involving a sizable flight of clients during a time of market stress. And are there perhaps scenarios that could potentially exacerbate that market stress? With respect to service providers, the council really is trying to understand who are the players in this market, what are their market shares, what are the reliance within the industry, are there substitutes, are there a variety of service providers that are used by the industry? Finally, turning to the resolution section, this section focuses on whether there are any broader financial market interconnections that could pose risks to an asset manager, investment vehicle, or fund if there was a failure. To be clear, the notice also acknowledges that there's certainly a long history of funds or asset managers failing and not causing any problems to financial stability. But to the extent that there are questions there, the questions are targeted at trying to understand what are the interconnections between a fund and an asset manager, both internally as well as more broadly across the financial system, and are there areas or potential areas where if there was a situation that could potentially pose some risks. So finally, as I wrap up here, I think it's worth echoing what Secretary Liu said in December. There is no predetermined outcome here, and no decisions have been made in terms of next steps or the identification of any risk. Indeed, at its heart, the Federal Register notice is a recognition that more information is needed, more engagement is needed, more discussion, more analysis is needed. And once that engagement, discussion, and the comments start to come in, and the council does additional analysis, the council will be in a much better position to understand, to the extent there risks there, and to the extent that there are risks, do those risks rise to such a level that there are implications for U.S. financial stability? And with that, I thank you very much for your time, and the council looks forward to engaging in the coming months.
Good morning. Does this happen automatically? Okay. There's Patrick. I can talk about those again. I am going to spend a few minutes this morning talking about two things. One is the conceptual issue of how one separates the two kinds of risk, thank you, that people have spoken about. That is investment risks versus systemic risks. And the other, if there's time at the end, I'll say a few things about operational risks at large asset managers. But before I start, I need to make it clear, this is a new thing for me. I have to say that these opinions are entirely my own, and they have very little, if anything, to do with the commission or the staff's opinions on related issues. So let me start by explaining, to be clear, how the SEC views investment risks. Basically, there is considered to be a variety of investment alternatives. There are a variety of investors with different risk preferences and beliefs. And the capital markets, including asset managers, allow the instruments and the investors to get linked up in a way that the investors understand the risks they're undertaking. So disclosure is a really big deal at the Commission. Disclosure, to the extent that we can do it, because sometimes it's very complicated, disclosure is aimed at making sure that the investors know what risks they're getting into. And later on, they might be unhappy about the outcome, but they won't be shocked or surprised at what happened. Now, the ability of the financial sector this way, the market sector, to absorb risks is pretty impressive. Yesterday, the markets closed at prices which made the U.S. equity market worth about $21 trillion. It's about 120% of GDP. 1% of that is $200 billion. And so I looked over the last 5 years at the number of days when there was a 1% loss in the U.S. equity markets. And the answer is that about 11% of the days over the last 5 years has seen a $200 billion loss in the equity markets. About 3.5% of the days in the last 5 years has seen a $400 billion loss in the equity markets. Now compare that to the banking system's equity capital, which stands at roughly $1.5 trillion in book value terms, which I don't like, but that's what the FSOC believes in. So what that means is that every 45 days, every 45 calendar days, the equity markets absorb a loss that's equal to more than 25% of all the capital in the banking system. So the notion is that this is a source of risk, an ability to absorb risk without untoward onward implications that is really, really very substantial. So the difference between the claims in the equity markets and the claims in the levered banking markets are qualitatively different. It's important to recognize that. The key difference is based on leverage. And that's why the SEC views disclosure as so important. Now, the chair in December gave a talk where she was talking about some of her goals for the coming year, and several of those goals were prominently associated with identifying risks in the asset manager space and informing investors about those risks. So they have to do with fund liquidity standards, they have to do with the disclosure of those standards, they have to do with possible revised rules about leverage and the use of derivatives in mutual funds. And of course, the SEC will have a lot to do with the stress tests that are mandated for mutual funds and asset managers. So in the disclosure dimension, we're aware of some of the shortcomings, and we're very interested in making sure that people understand what they're getting into so that a $400 billion drop does not cause all hell to break loose. Now, the interesting, and the reason we're here, the interesting issues, though, are where are their externalities? Nellie mentioned the possibility that the fund manager's optimal liquidity position is different from what a social planner would choose because of the possibility of runs and social externalities. Simple disclosure here is not sufficient, but the challenge is distinguishing between losses that everybody knows are possible and these external effects. And the thinking here has not always been terribly clear. So let me give you an example. This comes from a one-year-old, almost exactly one-year-old FSB document where they're looking for methodologies for identifying non-bank, non-insurance global SIFIs. Page 17 there says, if an entity has a significant amount of outstanding commercial paper, this could mean that its failure would have a negative repercussion for the CP market, which in turn could have an impact on other financial institutions that issue commercial paper. That's what I sometimes refer to as a thought-free statement. It says, sure, there could be big losses, and look at all the horrible things that might happen under some unspecified circumstance. I think we have to be very careful about that because it does a disservice to the notion that there are or there might be genuine systemic considerations. We've also got some could impact other institutions. A couple of pages later, they say, they're talking about this liquidity issue, and they say, for example, the failure of a market intermediary could seriously disrupt certain funding. Now, every time I see disrupt in this context, I'm tempted to say, what does that mean? What do you have in mind? What does disrupt mean, and how does it follow from, in this case, the failure of a market intermediary? I'm not saying that there isn't anything here. I'm saying that the language is very challenging. Now, this statement goes on to make a statement about not identifying risks. So the same statement goes on to say the focus of the methodology is identifying risks to the financial systems rather than risks to investors. That's clear. But it then goes on to say, at the same time, large client losses could also result in the loss of investor confidence, posing risks to the integrity and stability of the financial system. Well, that's not so clear. Okay, now, that's a year old. I think we've come some way since then. And the document that Patrick was talking about, which if you haven't read it, I urge you to read. It's remarkably well laid out. It's really nicely laid out. And in the liquidity issue in particular, they've got what appears at first and maybe even second glance to be a much better phrased question down the bottom here, which says, the Council is interested in exploring the ways in which investors in pooled investment vehicles could have greater incentives to redeem than if they were to sell a direct investment in the financial assets comprising the vehicle's portfolio. Okay, so are there accelerants associated with holding these things in shared investment vehicles? On third thought, the problem with this statement is that it sort of implicitly assumes that the assets in the world are fixed and we're making a decision about how we package them. But in fact, the reason people are holding more illiquid bonds or foreign bonds is because there have been technological innovations that make it economical for them to do so. So different people are holding, developing market bonds, different people are holding illiquid bonds, and they're being held in a different form. So there are two changes going on instead of just one. And I think we really have to be careful what the comparison is. I guess that's been said a couple of times already. What's the comparison to which we're making when we talk about systemic risk, or we talk about the possibility of external risk? So language you might say, well, he's just picking on odd language. I don't think that's true. I think there's a legitimate confusion about how to think about these risks and how they manifest. And with respect to this one, I'm not sure what the policy response is. Suppose we decide that too many people are exposed to illiquidity risks. The SEC would say, well, disclose, make sure that we do the disclosure right, and they'll understand. What is the FSOC level policy that results from that? Do we say no more ETFs based on foreign bonds? I think we ought to think about what we can do about the risks that we might identify as a process of trying to identify them. So that's really my big message today, which is that it's very hard to find clear thinking and clear statements about what the risks are that are systemic. The last thing, very briefly, what I'll say is this issue about operational risk, which is one of the four characteristics of the FSOC document. Chair White also talked about that recently, but I don't have a quote for her, talked about that recently. And here's a case where the SEC just implemented Regulation SCI, Systems Compliance and Integrity. That applied to trading platforms primarily. And the notion was that there's an external effect, there's an incentive to ignore reliability in trading systems. Because what attracts somebody to a trading system? The ease of execution, the value of the execution, the cost of the execution. And the competitive pressure to say to customers, if you're a trading platform, oh, by the way, I hardly ever go down, is further down the list. So we thought that there might be sort of a competitive reliance on system compliance and integrity. And so there's some new rules for them. And in that context, I think the same thing is worth exploring, and certainly the chair is talking about exploring this in the context of large mutual funds. So for example, Fidelity has something like 17 million accounts. I don't know what would make the management company go down, but if it did, we've got 17 million account holders who want their money to be somewhere else. So the question is whether that is a systemic risk and whether the kind of compliance that we've been requesting of the exchanges would also be applicable or appropriate for the larger asset managers. So I think there's some work to be done in terms of the operational risk, either in new rules or in figuring out what the dangers actually are as opposed to what the dangers might be. And the SEC will certainly be working on that. Thank you very much. So we're up here. Alphabetical order, right?
You're here. Yes.
You are going to be first, and then Delhi will sit.
You're here. Before we open up to the audience questions, what would be useful, one thing that would be useful is to talk a little bit about two things that you each have hinted at, but is worth, I want to give you a chance to interact on. One is, what kinds of information do you not have that you need to answer questions like whether there is or is not amplification, whether there is or is not redemption risk, et cetera. I'll lay some questions out, and then you can go from there. Second, obviously, is the question of how the agencies interact and work together on this effort, since, as Patrick noted, all of this crosses jurisdictional lines. And my last question is how, if it is knowable now, does this relate to the increase to efforts beyond the U.S., to international efforts? But
Go ahead.
yeah.
So there's a lot there. Let me start with kind of the interaction on the council and in terms of particularly in putting the Federal Register notice together. And I think you were implying kind of the role of the SEC and some of the other regulators. And, certainly given where the SEC sits, we rely on them tremendously. And, their role was, they were kind of front and center in, putting the Federal Register notice together. And, that's completely entirely appropriate given where they sit. They're closest to the action. They understand the issues. But at the same time, I think the broader perspective of the council and the other regulators, inform the sort of the systemic risk aspect of the council's work and kind of the mandate there. And, I think, as the SEC has noted, that, that's a complement to what they're doing.
Want to talk about what information you need?
Yeah, I think the information issue is an important one because we frequently hear when we're talking about systemic issues, someone say, gee, I don't know all about a particular sector, I wish I did. So there's a long list of information that we'd like to have. I think the thing that I would most like to have might be the thing that is least obtainable, but I would really like to understand, let's say, irrational contagion. There is a belief, a widespread, and I'm sure with some foundation, a belief that people behave in non-rational ways in response to certain kinds of surprises in financial markets. And I've always had trouble, why should there be a run on bank number 2 if bank number 1 fails, for example? Well, maybe it's because bank number 1 is known to have the same kinds of exposures as bank number 2. Maybe it's because bank number 2 is feared to have the same kinds of exposures. But I would like to know more about that, and I would like to know more about the extent to which disclosure can improve that situation and sort of confine or limit the external implications. So I'm not sure that's exactly data, but that's certainly a kind of fact that I would love to understand better.
So I'll start with the first one, which is what kind of information do we need? I spent a little time in my remarks on that. 2 areas for mutual funds with liquidity and leverage. I think there is really very limited information on that in the sense of being able to aggregate and being able to identify counterparties. You can go to individual funds and read their prospectuses and understand that. It's hard work to do research and the kind of analytical work that's needed to understand this. I think it's not a coincidence that the limited research in this area on liquidity is done in the area of stocks, so this is not just the mutual funds, it's also about the underlying securities. It's difficult to get. So that is an area. I think the work in derivatives, and this is not just about mutual funds. Again, derivatives work is there are a lot of players. It raises counterparty issues, and there's every derivatives market involves more than banks, and understanding and for the players in the market and for the investors, I think is important. So those are 2 areas I would highlight. I guess I'll mention one thing on how do the agencies work together. So obviously we work through FSOC. We also do quite a bit on bilateral work. So the Fed historically has worked with the banking agencies, and it will continue to work with the banking agencies outside the FSOC. We meet regularly with the SEC staff on asset management issues. The Fed actually has an interest in asset management issues. Some of the bank holding companies are some of the biggest asset managers. Also, in addition, as we continue to change capital requirements and liquidity requirements at banks, it without doubt will have effects on the broader financial system. So that's an area that we're spending time on. So this is not all through, just regulatory agencies have to work together, and they do. So,
If I could just make one point on the data, and I tried to get at this in my remarks, but I think there are two aspects to the data. There's the data to help inform the council's risk analysis and kind of the next steps, if there are any. But there's also the aspect of data. What data would be good for market participants? What data would help transparency? What data would help market participants manage their risks? And of course, the two kind of inform each other. But I mean, I think that's an important piece of context.
Apropos of that, let me just add one thing. You can imagine that there are times where privately it's optimal to be opaque, because if it's opaque in an emergency, you can turn to the government or some other deep pocket and say, "Gosh, nobody understands me, but I'm really solvent." And so one of the things that bringing more market pressure to bear on people will do, I think, is reduce the value of being opaque and increase the value of being transparent. And that goes exactly to Patrick's point.
To what extent, if any, can you talk about, you've been very clear at the process is we analyze the nature of risks and then we think about whether a response makes sense, keeping in mind Peter's point about compared to what, et cetera. To what extent, if any, can you comment on a sense of timing or duration? And but it's obviously something which you probably think about in your own lives, but I'm not sure whether there's any use.
So I can try that first. I don't have an answer for you on that. I think that we're not on the clock here per se. I think clearly there was a lot of time invested in putting together a notice that seeks to ask the right questions and to create a framework for folks to engage with the council and the different member agencies. And I think it's important to let that play out. And if you look at the 4 buckets that are outlined in the notice, I mean, these are fairly distinct buckets. I mean, there are some overlapping issues, but they're not necessarily going to start and end at the same time. And I think it's important to be flexible.
Are there other, since you cover the broadest mandate of the council, are there other information areas that you want to highlight? Since part of the reason for doing this panel, obviously, is to elaborate on the notice in the hopes that you all will comment and provide the information that these folks need to do their job.
So I guess I would say, I mean, sure, there are several dozen questions in the notice that asking for specific data and information and input. But I think it's worth stressing that in each section of the notice, there's an avenue for commenters to submit other information or other data that isn't specifically raised. So we don't feel like we should be limited in the types of information that people want to share or comment on.
Okay. Can we have questions from the audience?
Thank you.
Yes. Wait for the mic.
So this is to Mark.
Please identify yourself.
Oh, I'm sorry.
Actually, what I would like to do is get a couple of questions, since our time is condensed. If I can get three or four folks to ask questions, then I'll let the panel. I'll get to you next, Matthew. Okay. So ask your question, and then we'll.
Yeah, I'm Marcus Stanley from Americans for Financial Reform. This is to Mark, and Nellie may also have some views on it. Mark, you talked about losses in equity markets and how the market could absorb that. I was wondering if you've thought about the difference between something like equities and sort of money-like assets that are thought of as safe assets and are money-like. No one is relying on their equity wealth to meet their payroll this week or to act as collateral for their regular flow of funding. And there are different kind of dangers when those kinds of money-like assets and transaction accounts are hit versus equity. So what parts of the market are money-like in that way? How are asset managers connected to that, and what risks does it raise?
Okay, Matthew.
This is Matt Richardson, who was on the earlier panel. Yeah. So this is to, I guess, to Nellie, Patrick, and I guess also Gaston in the previous panel. In
through cyberspace, right?
Yeah, that's right. In discussing first mover advantage and the data issue, it seems like you can get at that question to the extent that if you had the mutual funds price of each of their securities that aggregates to the NAV. Then you have transaction prices. You could look at lead lag relations to see, in fact, whether or not the liquidity shock is being priced into the underlying asset. And for high yield bonds, because of Trace, insurance company, NAIC, and if you can get the data from the mutual funds, I think there's probably enough data there that you could get some idea, at least for that sector. So you might want to think about that.
We got a couple more, and then
This one's probably for Nellie.
identify yourself. Sir.
Nancy Jacqueline Seiss. You had a chart up on credit derivatives and the degree to which that market's dominated by dealers. We now are getting more Basel rules on capital that has to be held against derivatives by those dealers, and also margin regulations. So my question is, should asset managers now start to prepare for reduced liquidity in those markets too, as the costs of those businesses go up? And this gets to the ICI presentation at the front end that said, to some extent, asset managers are using derivatives because the markets and the underlying assets, in fact, are illiquid, and the derivatives markets were regarded as more liquid. And so, do we now have another kind of issue of liquidity for these folks?
Okay, why don't we, since our time is constrained, that's why I figured we'd get a few questions in. Do you want to pick and choose and Duggan as you go? Nellie?
I'll start with the last one first, the one on credit derivatives and margins. So I think that is I think it is the case that if you raise the cost of some kind of intermediation, it will likely reduce liquidity. I mean, and in some sense, regulations, by definition, will raise some costs. The idea, though, is that the expected benefits exceed those costs. I think the concern generally with the sort of, everyone mentions liquidity risk when they talk about funds with bonds or derivatives. General concern is, do current asset prices reflect what liquidity will look like in the next stress period? And that's unknowable. We'd love to know that. That's part of probably this irrational contagion issue, but I don't think it's measurable ex ante. But I guess that's my comment on that. And just to make the point that it's an open question to the extent that current asset prices reflect what market liquidity will look like in the next stress period, given the huge change in regulations we've had since Dodd-Frank. I appreciate the comment on how to try to get to liquidity risk in bond funds with the NAV looking at a lead lag. It is difficult, again, on bonds. It's just by nature they don't trade that frequently. There's just 50,000 different bonds, and equities are just tradable. But people are working on that. Ambitious PhD students are working on that, but those are hard issues. Go ahead.
Okay, well, let me respond to Marcus in particular. Thank you. Respond to Marcus in particular. The fact that some people want to hold equities, some people hold money market funds, some people hold bank demand deposits. That's sort of a feature of the financial system, and that people with particular risk preferences, maybe a risk preference over part of their portfolio, can select different kinds of investments. I think one of the things that we learned from the crisis is that sort of Modigliani-Miller, which countenances the fact that you can always raise more bond money if you pay a high enough interest rate, doesn't work in certain kinds of short-term markets. Why? Because in those short-term markets, probability of repayment is preeminent. And so the fact that you might get a couple more basis points if you're lucky isn't really relevant. So I think that those are different parts of the market, and they deserve different kinds of management and different kinds of asset holdings. So that's the connection, to your question about asset managers. They're going to provide different products for people with different preferences. The other thing about the asset prices reflecting future stress, which we would like to know about, but I'm struck by, I keep coming back to a paper that was written for the Brookings papers on economic activity in 2009, where, I can't remember the authors. They were talking about whether the market thought seriously before the crisis about the probability that that high yield mortgages would collapse. And the answer was yes, everybody thought about it, and everybody assigned that possibility a very small probability. So they didn't worry about it very much. So it might be very hard if we think that seriously stressful events are unlikely. It might be very hard ever to identify whether those events are impounded in the prices that we see.
By the grace of the host, we've been allowed 5 more minutes, so let me get a few more questions on the table. The gentleman 5 rows back.
Somebody can't count.
Oh. Pardon? Yeah.
Raise your hand again.
Raise your hand. Yes. Sorry.
Thank you very much, Larry Checo. Nellie said something very interesting about entering another stress period. Do we not think we're on the verge of another stress period, given what's going on with global warming, global terrorism, and something nobody predicted with this dramatic decrease in the oil prices? And does this not call for greater liquidity and capital holdings? It would seem to me, I just don't want to go through what we went through these last 7 or 8 years. And to, I think it was Mark's point, how come these people didn't see it? Mr. Greenspan has 400 accountants or economists in the Fed, and they couldn't see this thing coming? It just surprises me amazingly. Thank you.
A couple more questions?
I think we should collect more questions.
Yeah.
My name is Li Yang. Thanks for all the presentation. We have a Department of Treasury, we have FRS, and we have a SEC, and if we have also the Department of Justice. That would be great, because we had to look into the problem of this financial institution, and we have to look into the data set, the credibility, and even to collect the data, whether it is really accuracy or manipulated. And so that's the thing we have to look into. You have the comment to solicit the public comments. The problem, those do not really send to like the investors or like customer clients. So I just wonder if you can really coordinate together. If a complaint sent to one agency, you can bring all together so you have all the linkage. And so now we want to have a credibility of the agency yourself. Do you have audit to your own agencies? Do you have audit to the financial sectors? No, we want the FRS, we want the Department of Justice, we are SEC, have a real...
If we're going to have time for answers, we're going to have to limit the time for the question.
Credibility, so whether you have stopped the revolving doors and we make a really efficient market.
One more, and then we're going to. Okay. Want to speculate on the extent to which?
And remember, you're on television.
Right.
Okay, so first I'll start by repeating my disclaimer that I'm speaking for myself. So I think the probability of, the way, since the crisis, I think most people focused on financial stability recognize that the likelihood of predicting big shocks accurately is extremely low, and that shocks are by definition unexpected. And the focus of financial stability efforts in the US and globally is to try to increase the resilience of a financial system to any kind of unexpected shock that could come along. So I think it's sort of it's almost, by definition, we try to take out, can you predict the likelihood of a random shock? And, but it does not say that you can't try to improve the robustness of a system to whatever may come along. And so that's where we're focused.
Actually, no. First, we're not. Do you have anything you want to say, or should we?
Well, I mean, let me emphasize. emphasize the point that Nellie made, which is if people expected a crisis, if people thought that a major sector was falling apart, then they would take steps to protect themselves against it. Okay, there'd be ways. We can't protect ourselves in the aggregate from it, but we can rearrange the claims. And so something that is truly a crisis is also going to be truly a surprise. So the notion that we should have seen something like this coming is a very, very high bar. And I hope the FSOC is careful never to say that it can predict and head off crises, because that's a loser's game.
And we will give the last word to the FSOC.
So, Mark, I wasn't going to say that. But I think I would note, in terms of Nellie's point and sort of the consequences of shock, and the example was oil, but I think more generally, when the FSOC convenes and talks about risk, both at the principal level and the staff level, there are a variety of perspectives on what's going on in the marketplace. And if you're on the banking side, you may have one perspective. If you're on the securities or the commodity side, you may have another perspective. So I think it's crucially important to bring people together to share those perspectives. And that's, looking forward, that's hopefully a mechanism that would be helpful going forward.
Great. Let us thank these folks for sticking around.